Hey everybody, this is Jack Allwild with another money episode, and today we are discussing bonds. Now, what is a bond? A bond is a fixed income investment. It represents a loan from the investor to the borrower. The borrower is often a corporation or some sort of government entity. It could be a city, it could be the federal government, but the investor who has money gives money to the borrower for whatever project they are looking to undertake. And in return, the borrower sends periodic interest payments back to the lender until it is paid back. So how is this different from stocks? So stocks, you're actually paying into a company and you are getting a share, you are getting a piece of the company. A bond is more you are just giving them a loan and they are paying you back. Now, how do you determine the interest rate that the borrower is paying the lender? Number one would be the credit quality of the borrower. How likely are they to repay you back? Now, if you were to give money to the federal government, it is thought that is a risk-free because they will not default. They can at least print the money to at least pay you back. Now, your purchasing power on those dollars that you're receiving might be lower, but you will get your money back and they will fulfill their agreement. So let's say you have a friend who has made some questionable decisions in the past, just having a lot of late nights out, a lot of beer, a lot of partying. They come to you, they want $10,000 and they say they'll pay you back, but you're not so sure because they don't seem like the most trustworthy person right now. So you might require them to pay you a very high interest rate for you to give money to that person. And it can be analogous to a corporation or any government. Another factor would be the time that you're lending this money out. Now, if you're lending money for a year versus 10 years, one would think you would want to charge a higher rate of interest over a long period of time because so many things can happen over that time period. If you give money to a corporation, you give $1,000, you're only getting interest payments for the first 9 years, and then you'd receive your principal at year 10. Well, a lot can happen. Who's to say that company will even exist in 10 years? Or if the payments don't keep up with inflation like we're experiencing now, is that really a good investment? So that's something to think about. Now let's do an example and we'll go over some terminology here. So here you see that we are paying $100. So that's what this negative shows. It's we're taking $100 out of our pockets. And in return, we are getting what are called coupon payments. This is the interest payment each period. So we get $4, $4, $4, and then the fourth year, we're getting our interest payment of $4 plus our original $100 that we laid. And the $100 is often called the face amount because this is the reference amount that is used to calculate the coupon payments. So the $100 times the coupon rate of 4% is $4, and that's what we get. Now, if you look here, so this is the present value at time zero. So we basically have paid our $100 and we're looking for the present value of these future cash flows here. And that can be shown here. And if you discount them at the same rate as this coupon rate, you're going to see that they are trading for $100, which is exactly what we paid. And at that amount, we call that at par. So it's trading at the face amount. Let's say at time one, interest rates. So now we're sitting. So we've collected our $4 here, and now we're calculating the present value of these three remaining payments at time one. So we're like sitting right here on the timeline, and we're going to collect $4, $4, and 104. But let's say now the interest rate has gone up. Interest rates have gone up, so the bond price should go down because you would need less money to pay for these future payments. And you can see that now at 5%, this bond would trade for less than $100. And when that happens, when it's less than the face amount, we say that's trading at a discount. So now, let's say we move to time 2, we collect our second $4, and we still have $4 at time 3 and then 104. And let's say interest rates have now dropped. Let's say they now drop to 3%. You can see at 3% at time 2, we're now trading above the $100. And when that happens, they say it's trading at a premium because we are above the face amount of $100. Okay, so now we're at time 3. We've collected our third $4 payment. We still have one 104 payment remaining. So if it goes back up to 4%, it's trading at par again. Let's say if it went down to 2%, it would be trading even higher. If it went to 0%, it'd be 104. And you can see, so one thing people ask, well, why would anyone buy a bond when the interest rates are so low? And the thing is, if they keep going lower, the actual price that someone would be willing to pay for that stream of payments, if that is the rate, this amount goes up and up. So it's kind of like just hoping someone else would be willing to buy it, even though you're only going to be collecting 104. So that kind of shows you how that could happen. But let's say it's just 4%. We're now, once again, at time 3, we are trading at par of $100, the face amount. Now, one question you might have, well, Jack, how do I even go about buying bonds? And now I only own bonds through like my retirement fund, so you can get them through your brokerage's accounts. Like there are bond ETFs. The only thing I'd say on that is you probably should look for low expense ratios, so you're not paying a lot of fees. Bonds are clearly a good diversification tool. They take out a lot of the volatility that you'll see, and it's just good to be diversified, especially if you're not super in the weeds on a lot of financial instruments. And if you are interested in treasury bills and notes and all these different bonds here, you can go to treasurydirect.gov. It seems to be a fairly clunky website, but this is where you would go if you wanted to buy treasury bonds like through the US government. So hopefully you found some value out of this, and I hope to see you in the next episode. Thanks.